Hi, I'm Joy Norwood with the Superior Property Group at Keller Williams, and today I'm going to talk about this 50-year mortgage because there's been so much talk about it, post about it. I've seen it online, and so I want to kind of talk about that and what this would mean to first-time home buyers or young people or that's wanting to purchase their first home. Okay. The 50-year mortgage. I am a numbers person. I am an accounting major. So to make this determine, what makes sense, I said, let's look at the numbers because this numbers don't lie. Okay. So what I did is I got my financial calculator. You can download a handy one on your phone too and key these same numbers in if you want to check me. So I wanted to do an apples to apples comparison on a 30-year mortgage versus a 50-year mortgage. So here we go. I keyed in I used a $200,000 mortgage as the baseline, and I'm using 6%. Reason being, okay, I got online yesterday and I said, what's the average interest rate over a 15-year mortgage? And it said like 5.5 to 5.8. So I said, okay, what's the average interest rate over a 30-year mortgage? And it said 6% to 6.2 or 6.3. I can't remember. Okay. So I just said, you know what? I'm just use 6%. And so for that, then my thoughts on that. Okay. And if you go to Google, I did that too, and the AI pulled it up because I said, okay, over the life of a loan, what do the interest rates do? And it'll tell you the same thing between the 15-year and 30-year. We saw the rate was higher. It says that due to the risk that lenders take on for longer long-term periods, that interest rates are typically going to be higher the longer the term. Makes sense, right? Okay. Because, people get older, they might lose their job, things happen, they go into retirement, whatever. So the longer that term period is, the more risk that lender is taking on. So they want more money, okay? Show you my financial calculator. Over a 30-year term for a $200,000 loan at 6% per year, the monthly payment will be $1199.10. Total payments over the life of the loan will be $431,676 with the interest. Okay. So just for laughs and giggles and just to, not to even change this interest rate, I'm going to just change this to a 50-year. Let's look and see what the payments are. Okay. Once I change this to 50 years, okay, a $200,000 loan at 6%, and we've already said the interest rate is likely to be higher because they want more interest when the loan term is longer, but we're going to say it's the same, okay? Over 50 years, your monthly payment will be $1,052.81. Your total payments will be $631,686. Okay? So what did we just see there? That means that you save $146.29 a month over 30 years for you to pay, which is a total savings now of $4,388.70 if you annualize that out and multiply that by 12. And it also means that because of the extra interest that you're paying over the life of the loan for that 50 years, that you're actually going to pay $200,000 more dollars for that house than you would have paid over a 30-year period of time. So to save less than $4,400, you're going to pay $200,000 more dollars. That makes 0 sense. I mean, I would not do that. It's no way for anyone to rationalize that. And if your interest rate is higher, it means, like, I went it to 6.2%, just for laughs and giggles, and change it to 0.2% higher, just to give you a higher interest rate, which the lenders are typically going to likely do. You would pay $217,000 more dollars for that same house to have it financed over a 50-year period instead of a 30-year period. That doesn't make any sense. The only way that they can make it equitable, and I ran the calculations, and like I said, you download the app and key it in also, to make it about equal to what people are paying today, would be to make the interest rate be like 3.6%. But that would be apples to apples, again, what they're paying today. And then they'd be paying still over a 50-year period of time. Makes no sense. They could just pay the interest rates today over 30. Then, if they make the rates lower than that, what would happen is we would likely see what we saw during COVID, which would mean the people that already own homes and that are able to purchase a home and put money down because they have equity in their properties, they would begin coming in, purchasing these homes at this 50-year rate. And then they probably wouldn't care. I mean, 50 years is more than some people's lifetime. And by the time people start buying properties, which they can start about 18, if they even took out a loan then, there'll be retirement age by the time they'd be able to pay it off. And most people don't buy homes. I think they said the first time home buyers were coming in now about age 30. So, some come in younger. I bought my first home younger. But if people on average are like 30 or above, then they're looking at being 80 plus years old before they can pay their home off. And home buyers, they're able to, if they take out a 30-year mortgage, they could potentially pay it off, make extra payments, have it paid off before they retire. And they're able to have money when they go into retirement. Some people are able to take out equity loans or refinance their homes and pull out money to be able to pay off bills or upgrade their home and renovate it, or whatever they choose to do with those funds. When somebody has a loan over 50 years and they're still making payments on the house, they're not as likely to have extra discretionary funds where they could be using for doing the updates and renovations, which means that by the time someone gets ready to purchase his home, or it goes back to the bank because the person is passed on, or whatever the case is, the home is not even going to be in condition where somebody else is going to want to come in and buy it and pay whatever it is for it. So it's going to cause likely also loss of home values. These are the things, if somebody wants to encourage first-time home buyer purchasing, to me, what should happen is the government should provide some type of subsidy or grants or whatever to the city, states, what have you, that apply for them, or just give them some money each month or each year and allow them to be able to, the blighted and dilapidated properties, to be able to buy those, or if they're back owned by the city or the state, be able to have a contractor come in and fix those homes up, make them nice, modernize them, renovate those homes, and be able to offer those homes to first-time home buyers and low-income families so that they're able to purchase a home and actually have home ownership. That would make more sense. Or offer some type of subsidy or grant to contractors to encourage them to buy homes that they will then turn around and sell. In my market, I would say from $150,000 to $200,000, either new construction or a home that needs some work that they can turn around and sell, which will help get rid of blight, dilapidated properties, and homes that need work in the area. And it also offer a place to stay for low-income families or families that are first-time home buyers, where they can move into something that they don't have to automatically go into and throw money at that. That would make way more sense. So, or offer some type of grant to people that own the property and allow them to be able to fix up their homes, to be able to sell them for, a little bit more money, and offer a first-time home buyer something nicer to move into. Or just offer some type of cash offer to these people that don't want to fix up their homes, or maybe people that get the home through probate don't want to fix them up, and they just want to get cash out of the house. City buys it, get a contractor to come in, fix it up, and offer those homes to first-time home buyers and young people that want to purchase homes. Also, I see these homes come through Fannie Mae, HUD, whatever, that are been foreclosures. Fix those homes up, the ones like in the $150,000 to $200,000 range especially. Leave them out there where only first-time home buyers can buy them for a certain period of time, and sell those homes to those first-time home buyers and allow them to purchase it under a regular 30-year mortgage. Because the 50-year mortgage is not making anybody any money except the lenders. It's only saving people on a $200,000 home $146 a month. And they're going to pay $200,000 more in interest over the life of that loan. It makes absolutely no sense. So I hope that, I'm going to share this. And I hope that people in, the city government, the state government, federal government, whatever, if they're looking for a solution, that they take these solutions to heart. Because a 50-year mortgage is not the answer for first-time home buyers and young people that are wanting to purchase a home. For them saving $4,400 but paying $200,000 more over the life of the loan makes zero sense. And then they will not own that property probably ever. They have a potential to be able to own a property, and one that's nice, if they follow the suggestions that I gave. And if they want to truly be offering something to them and not something that just makes the banks more money, that this would be what they should do. So I hope that this video has been helpful and informative. And like I said, you can yourself download a financial calculator and key in these numbers, and you will see that, it's more beneficial for people to keep the 30-year mortgage that they have, because they actually have a potential to own the home, maybe be able to borrow against their home to keep it updated, or whatever it is that they choose to do, and leave an asset to their family, versus a 50-year mortgage where they will likely not ever be able to do that. And once their family gets it, if they haven't been able to maintain the home, the value of the home has declined. And now they're looking at, how can I make this house, be better and be able to, pay it off and keep this. And so the 50 years is not the answer. Some people have asked me what I think about it. So these are my thoughts about it. If they continue to talk about it, or they bring something else forward that might be a better answer, then I will talk about that as well. And like I say, the only way to even make it apples to apples now is 3.6%. But why would you take on apples to apples to pay the same payment and take on a note that's 20 years longer? So the interest rate would have to be significantly lower to even make it beneficial, like 2%. But again, then you would bring in the people that already have equity in their homes, and other people that, can afford to pay 10, 20, 30, 50, 100,000 over ask, and they'll be taking over those homes again and just buying them, knowing they probably never pay them off, but not caring because they have a lower payment every month, which will bring on a whole nother issue later on down the line. And then it will still end up pricing the young people out, and the prices of homes will skyrocket because as the interest rates go down, home prices go up. So it will further exacerbate the current issues that we have today. So again, my suggestions: fix up the homes that we have currently in the area, dilapidated, blighted properties, homes that need work, homes the state owns, HUD homes, Fannie Mae homes, any other foreclosure homes. Buy those, fix them up, and offer them to home buyers that are young people, first-time home buyers. Let them have preference for a certain period of time to be able to buy those homes, 150 to 200,000 or less. That would be the best option. That's in my market. In your markets, in larger markets, that lower price range for first-time home buyers may be more than that. But for my market, that's what it is. And so where a lot of people more people would be able to get into homes that are first-time home buyers. Some people need less than that. They need 100,000, 125,000. You know, if there's homes that they could do that with, also do that. That would be beneficial in my market, because no one wants a home that they have to go into and it's a lot of work and they have to throw money at it and they're paying for it, and they can't be proud of where they live and what they're paying for each month. So they want to be able to be happy with what they're paying for each month too. Because when they put these homes out there and they need a lot of work and they're just sitting there, the only people that do come in and buy them a lot of times are going to be investors. And then they come in and some of them will fix and flip them, but some of them will fix them and renovate them, and then they're going to charge a lot of money for rent, and we still don't have owner occupants in those homes and people that can actually afford to live in those homes. So again, that would be most beneficial and more beneficial, I believe, than offering a 50-year mortgage that would cause them to pay $200,000 more on a $200,000 home than what they pay on on that same home over a 30-year period of time. So I hope that this video explained a lot and was very informational. Like I say, you can download your own financial calculator. Just get you an app and go in there and go into loans and key these numbers in, and you will see this same thing, because I'm all about numbers. Numbers are facts and numbers don't lie. So again, I hope that this was very informational, and I will see you on my next video.